Hello everyone and welcome. Today we are going to talk about something that might sound complicated, but I promise you, it is simple. We are talking about the foundation of all money, all business, and all personal finance. This is the accounting equation. Now don't let that word accounting scare you away. This isn't just for people in suits or big corporations. This is for you, this is for me, this is for anyone who wants to be strong, smart, and secure with their money. Understanding this one simple rule is the first step to taking control of your financial destiny. It is the key to knowing where you stand and how to move forward with confidence. So what is this magic formula? It is this: assets equals liabilities plus equity. That's it. 3 simple words that hold so much power. Think of it like a scale, one of those old-fashioned ones with 2 sides. On one side, you have your assets, everything you own. On the other side, you have your liabilities and equity, everything you owe and what is truly yours. For your financial life to be healthy and honest, those 2 sides must always, and I mean always, be in perfect balance. It is a universal law of money, and once you see it, you cannot unsee it. This balance tells you the true story of your financial situation. This isn't just about numbers on a page. This is about clarity. It's about looking at your financial life with open eyes and seeing the truth. So many people walk around blind, not knowing what they have, what they owe, or what their net worth truly is. They make decisions based on feelings or guesses, and that is a recipe for disaster. The accounting equation removes the guesswork. It forces you to look at the facts. It is the most honest mirror you will ever look into when it comes to your money. It gives you the power to say, this is where I am, and now I can make a plan for where I want to go. Before we break it down, I want you to make a promise to yourself. Promise that you will approach this with an open mind. Forget everything you thought you knew about accounting being hard or boring. We are going to make this real. We are going to make this personal. This knowledge is not reserved for a select few. It is your right to understand it. It is your tool to build a life of financial independence. So, take a deep breath. Let's get started on this journey together. You are about to become more powerful than you were just a few moments ago. You can do this. First, let's talk about the first part of our equation, assets. This is the good stuff. An asset is anything you own that has value. It's the cash you have in your wallet or your savings account. It's the car you drive. It's the house you live in. If you own a business, it could be the computers you use or the products you have on your shelves waiting to be sold. An asset is something that can be used to pay off debts or can be converted into cash. Think of it as everything in your financial toolkit. These are the resources you have at your disposal to build your future and handle what life throws at you. Next up, we have liabilities. This is the part we all need to be very honest about. A liability is anything you owe to someone else. It is a debt. The most common examples are loans. Do you have a car loan? That's a liability. Do you have a mortgage on your house? That is a big liability. Do you have credit card debt? You better believe that is a liability. It is a claim that someone else has on your assets. It's the money you are legally obligated to pay back. Facing your liabilities is a sign of financial maturity. You cannot ignore them, or they will grow and take over your life. Now for my favorite part, equity. Equity is the part that is truly 100% yours. After you take everything you own, your assets, and subtract everything you owe, your liabilities, what is left over is your equity. It is your net worth. It is the value of your ownership. If your house is worth $300,000, an asset, and you have a $200,000 mortgage on it, a liability, your equity in the house is $100,000. That is the portion you own free and clear. The goal in life, financially speaking, is to grow your equity. You want to increase your assets while decreasing your liabilities. That is how you build real, lasting wealth. So let's put it all together. The equation assets equals liabilities plus equity shows us a complete picture. Your assets didn't just appear out of thin air. They were financed by either taking on debt, liabilities, or by using your own money, equity. The 2 sides of the equation represent 2 different ways of looking at the same things. One side lists what you have, the other side lists who has a claim to what you have, your lenders, liabilities, or you, equity. Understanding these 3 simple terms is the key that unlocks the entire world of finance. It really is that simple. Let's see this in action with a simple, real-world example. Imagine you want to start a lemonade stand. You are going into business. To begin, you need to buy some things. You take $50 of your own savings to start. That $50 cash is now an asset of the business. Where did it come from? It came from you, the owner. So, your equity in the business is also $50. Right now the equation is assets $50 cash equals liabilities $0 plus equity $50. See, it is perfectly balanced. You have no debt yet. Everything the business owns was funded by you, the owner. Now you need a nice table and a big picture which cost $30. You use your cash to buy them. What happens? Your cash, which is an asset, goes down by $30. But you gain a new asset equipment worth $30. Your total assets are still $50, $20 in cash plus $30 in equipment. Your liabilities are still $0, and your equity is still $50. The equation remains. Assets, $50, equals liabilities, $0, plus equity, $50. The numbers moved around on the asset side, but the total stayed the same, and the scale stayed perfectly balanced. You simply traded one asset, cash, for another, equipment. Business is slow, and you need more lemons and sugar, but you have no more cash. Your neighbor agrees to lend you $10, which you promise to pay back tomorrow. You now have an additional $10 in cash. Your cash asset is now $30, 20 plus 10. Your total assets are now $60, $30 cash plus $30 equipment. But wait, you also have a new liability. You owe your neighbor $10. So the equation is now assets $60 equals liabilities $10 plus equity $50. Look at that. It is still perfectly in balance. Your assets went up, but so did your liabilities. At the end of the day, you made $40 in sales. That $40 is cash, which is an asset. Your cash on hand is now $70, 30 plus 40. So your total assets are $100, $70 cash plus $30 equipment. This is fantastic. That $40 you earned is called revenue, and it increases your ownership, your equity. Your equity is now $90, 50 initial plus 40 profit. So, what does the equation look like? Assets $100 equals liabilities $10 plus equity $90. Every single transaction, whether it's spending money, borrowing money, or earning money, changes the numbers. But the equation always stays balanced. So why do we care so much about this balance? Because it is the ultimate truth detector. For a business, this balance is the foundation of all financial reporting. It ensures that the company's books are accurate and complete. Investors, banks, and managers look at a company's balance sheet, which is just a formal presentation of the accounting equation to judge its health. If a company has far more liabilities than assets, that is a huge red flag. It tells you the company is in a risky position. The balance provides a standard, trustworthy snapshot of where a company stands at any given moment. But this is not just for big business. This is for you. This is for your personal finances. You should be able to write down your own accounting equation. List all your assets, the cash in your bank accounts, the value of your car, your retirement funds, the value of your home. Then list all your liabilities, your credit card balances, your student loans, your car loan, your mortgage. When you subtract your total liabilities from your total assets, you get your equity. You get your personal net worth. This number is your financial scorecard. Is it going up or down over time? That is the most important question. Knowing this equation empowers you to make smarter decisions. When you are thinking about taking out a loan to buy a new car, you can now see exactly how it affects your financial picture. Yes, you get a new asset, the car, but you also get a big new liability, the loan. How does that change your overall net worth? Does it make you stronger or weaker? When you decide to pay down your credit card debt, you see your assets, cash, go down, but your liabilities go down by the same amount. This increases your percentage of ownership in your own life. You are buying back your freedom from the lenders. I want you to leave here today feeling approved, not denied. Approved to take control of your money. You do not need to be a math genius or an accountant to understand this principle. Assets equals liabilities plus equity. It is a simple truth that governs the world of money. By understanding it, you are no longer a passive spectator in your own financial life. You are an active, empowered participant. You have the knowledge to build a stronger financial foundation for yourself and your family, one balanced decision at a time. Now go out there and own your truth.